In high seas or calm, both opportunity and risk lurk just below the surface. Answers require in-depth analysis. Welcome to BlackFin Group's Shark Cage podcast, where experts dip below the surface of important industry issues in search of hidden opportunities.
Cheers, folks, and welcome to the Shark Cage BlackFin's podcast series. My name is Keith Kemp, President and CEO at BlackFin. I will be your host today. Our time together today is not a deep fake. There is no AI magic. It's real mortgage experts actually talking about opportunities and challenges in the mortgage banking industry. Quick shameless plug from your sponsor here at BlackFin. We are a team of mortgage banking experts that provides an umbrella of services dedicated to helping you operate more efficiently, effectively, and profitably. Okay, so today I'm excited to have someone in the Shark Cage who's become a dear friend of mine, Bill Corbet. Welcome, Bill. Happy to have you.
Keith, thanks so much. Super excited to be here. I think this is a very timely, interesting topic, and more than happy to help share some thoughts, BlackFin, with all of our friends in the industry.
Cool. Well, we're definitely going to have some fun because you put this gauntlet out there that's going to make it an interesting conversation. But before we jump into the topic, Bill, let me give folks a little background on yourself. Folks, Bill Corbet is a 30-year veteran of the mortgage banking and financial services industry. Bill has held numerous executive leadership roles overseeing capital markets, technology deployment, product development, risk management. He's held executive positions at community banks, independent mortgage bankers, and at a top 15 nationally recognized bank. Can I say Citizens Bank? If I can't, oops, I just did. Bill has worked on various projects with the likes of the Federal Reserve in Boston or with Toll Brothers, just to name a couple. Bill is a partner at BlackFin Group, and for the last 4 years, he has run our mortgage banking strategy consulting practice, where him and his team help mortgage bankers by conducting business reviews, helping them get their agency approvals, advising on capital markets, helping mortgage bankers optimize secondary revenues, or as I like to say, close the gap on revenue leakage. End of the day, Bill, you're a really smart mortgage guy, obviously, and every time I talk to you, I learn something new. It's one of the reasons I'm excited that to have this chat today. So great to have you, Bill. Let me let me kind of start off with the first question. So when you and I were talking a couple weeks ago, you made this bold statement. You said, now's the perfect time for regional banks, community banks, and credit unions to get into the mortgage business. And as you said that, I remember scratching my head because I reflected how just over the last 12 months, the mortgage markets have been decimated. The originations are down 70%. We've laid off thousands in this industry. IMBs are pretty much gone or fighting for their life today through M&A. After the SVB bank community bank failure, or the SVB bank failure, community banks started pulling way back on mortgage projects. They started tightening mortgage credit. Some of them even ceased all their mortgage originations divisions, and we even saw that firsthand when we were working with the community bank to help them start up their mortgage division, and they decided to completely step back and pull out and put the brakes on the overall project. They literally laid off all their new mortgage staff. So since SVB failure and the community banks tightened up credit, markets have completely really stalled when it comes to mortgage, almost like they're waiting for the bank earnings that started coming out this week. And as you and I talked about and saw, Bill, we're not seeing a lot more failures. We're not seeing any additional failures, really. So but despite that, there's still this huge question mark and negative sentiment hanging over the head of mortgages. So all that said, Bill, I mean, the last 9, 12, 15 months, and then, looking on the horizon, there's just not a lot of optimism in mortgage for some folks at banks, executives at banks. So why should a bank or credit union executive be thinking about starting a mortgage group today, Bill?
Well, so the first thing is the banks, credit unions have customers. Customers have life needs. And one of those major life needs revolves around housing. And that's a population that already has one or multiple account relationships. They're well established, recognized in the community. They've got brand recognition. But a lot of the things, if you're trying to attract a mortgage customer, that IMBs are struggling right now to fulfill, they've already got the kind of ready-made customer base. And again, they've got needs. And bankers as a whole need to, I believe, get out in front of that and be the ones in this time of turmoil to plant the flag and go, we've been a part of your community for 50, 60, 70, 80 years. We're not going anywhere. We're going to be here for you. And there are a couple of big underlying themes that help them in delivering that message. Right. So first of all, a lot of if you focus on just the mortgage numbers and things that come out from the MBA, if you look back at the world pre-March of 2020, it's very different. And when folks are looking at volume, revenue, cost to produce, if you don't look back beyond the beginning of the pandemic, you're going to have an incredibly distorted view of the world. And when you look at, so for example, revenue per loan right now, everybody's focusing on it's down 50% from 2021. Well, it's still at, depending on how you look at it, at or slightly above the average of 2012 to 2020, for example. So that's, it's not all the doom and gloom that's out there. There's, and a lot of banks did not ramp up to the level that the IMBs did in, the refi boom. And so they're not going through the same level of restructuring, which has been if you're a company that's going through multiple rounds of layoff, that's a massive distraction. Meanwhile, the bank folks can kind of be chugging along and getting back on the front foot, because frankly, for the last a lot of arguments going back to the 07, 08, banks in terms of mortgage have been on the back foot. And some of it has been voluntary, and some of it has been just they've been behind the curve. And now I believe is the chance for them to get out on the front foot. And some of it is you kind of get really into little nuances. So, for example, I saw this, recently and have been a big proponent of it, of delivering loans if you're selling in the secondary market. Well, a bank has massive positive warehouse spread. So as short-term rates have gone up, when an IMB is struggling to get a loan out the door as quickly as possible, in a bank, that's all positive spread. And that dig down into it can become a significant chunk of their profit. So there's big picture things and there's really little nuanced things that give the bank an advantage. And especially, even with the liquidity concerns right now, if you're a bank and you've got any portfolio appetite, that's a great way to differentiate yourself in the market. Even if it's only 20% of your volume, it separates you from the rest of the pack, and it gives you some product options that a lot of other folks aren't going to have. And again, it's differentiation, but it's not compromising on credit quality, for example. I think you can even be stronger on credit quality and still separate yourselves from the pack.
So let me ask you this, Bill. I was, as you were talking, I was also thinking about, because you talked about the spread there, and how that can really help bolster up really the bottom line for the banks. But one of the things I heard a lot about as with this whole SVB bank failure is how the markets are starting to realize how quickly banks can lose depositors as they transfer their money, via their phone app or their on their iPad, uh, so quickly. It's not just a small, incremental withdrawal of deposits. So does the fee income that you make off of mortgage loans, does that help subsidize some of that, or help feed, or help bolster up the bottom line from that standpoint as well, to ensure that you're maintaining some revenue stream?
Yes. So if you're within a bank environment running a mortgage operation, you got to look at the capital requirement from two perspectives. One is your traditional bank perspective, which is if you're originating loans to hold on your balance sheet, there are capital requirements. And that's also where liquidity concerns a la SVB come into play. But if you're running an operation that has a significant secondary market component to it, where you're able to originate and sell loans on a flow basis, the amount of capital that that's absorbing is relatively small. And that's where you start generating the fee income. And by the way, in a bank environment where you're getting squeezed to raise deposit rates, that net interest margin throughout an organization becomes a bigger and bigger challenge. The first thing the CEO is doing is looking around going, okay, so who in this organization can generate fee income for me? Well, that's where you've got the mortgage banking type of setup. Mortgage folks are the ones raising your hand going, yep, we'll get you some fee income.
That's really good. Great insight. Thank you for putting that in proper perspective. Um, Obviously, there's a number of reasons why, serving your community, giving them loan options, having been a fixture in the community for 80 years, as you said, and then obviously the income aspect of that. But so I'm clearly seeing the reason why you would want to start your mortgage division. And would you also say that, that the best time to start is now, because is that part of what I heard you say a couple weeks ago, is the best time to start is now because there will be a wave and it will come back, and there will be a demand for more mortgages?
Yeah. So the mortgage market went through an incredible retrenchment that folks are digesting now. The reality is it's bringing origination levels back to where they were 2019-ish, let's say. It's the pace of change that's been the massive drag, and obviously the refi volume has completely gone away. But at the end of the day, when you step back and look at it, there's a housing shortage in the country. Housing is not that is not going to go away, and housing finance. People are going to have needs. The other thing is the group of loans that were done 2021, let's say, at the incredibly low rates.
Hmm.
Those people are out of the market right now. But eventually, life is going to take over. They're going to have life events occurring where the protecting their 3% mortgage is not going to be the determining factor anymore. So, and it's going to take a little while. Um, but I think when you look at some of the forecasts of volume steadying out and then building over the next couple of years, not dramatic. That's one of the factors. You've also got the millennial generation coming into now the prime home buying years. So the the opportunities are going to be there, and you know there's lots of folks out there that, and I subscribe to a lot of it, taking contrarian views that when everybody is doom and gloom is the best time to be looking for the opportunities. And again, I go back to my very first comment, which is if you think you found an opportunity, you've already accomplished the number one component of a business plan. Well, okay, I I think getting back into mortgages makes sense. The first question anybody should ask is, well, where are you going to get customers from? Well, as a bank, you've already answered that question, and your customers are going to have housing related needs. So why wouldn't you be focused on how to serve them?
Well said. Well said, Bill. Yeah, I completely agree with you. I think that the why is fully justified. And I think it comes back to a common issue that I see with firms that I'm consulting and meeting with the CEOs and chatting with them is that they're too often their heads down. Their heads down looking at what's happening today in the marketplace as opposed to heads up looking on the horizon about where the market is going. And the analogy you always use is, the Wayne Gretzky analogy of, we're not where's the puck at today, where's the puck going? And we've got to, as an industry, as a banking industry, as a mortgage banking industry, we need to be raising our head and looking on the horizon of where the puck is going. So I think
Yes.
that, I'm sorry, go ahead, Bill.
No, it's so true. And another analogy I use is a lifelong sailboat racer, right? There's a balance between if everybody is going to a certain side of the race course, if you go completely to the opposite side, it's called taking a flyer. That very, very rarely pays off. But if you look at what everybody else is doing and do your own analysis and have a different view and start to position yourself not all the way out to the extreme, but to one side of in sailboat racing, to one side of the fleet, then you can capitalize on the gains when you're right without committing everything in case you're wrong. So it's not an all or nothing, but it's you've got to have a bias and you've got to favor that direction, but not go all in and not make a stupid bet.
Yeah, and there's lots of control mechanisms out there, right? If they feel like they're going too big in mortgage, they can always raise rates and just price themselves out of the market, kind of slow down origination, right?
Absolutely.
So there's
Mortgage
different
rates are
mechanisms
one
and
of
strategies to be able to control your mortgage banking risk and be able to mitigate that risk as you go and the market turns accordingly. But if you're not doing mortgage, you don't have that option, right? You don't have that revenue option.
right.
So with all that said, Bill, let me transition to kind of the next question because, the why is obviously there. The benefits are clear if a bank is not doing or a credit union is not doing mortgage. Let me ask the next logical question after why, but let me ask you, when you mortgage lending is highly complex, and then you pile on all these compliance requirements. So what is the checklist of to-dos to get started? What are some of the challenges executives need to be thinking about at banks on their way to building out a new mortgage group? What does that punch list look like, Bill?
So again, the first thing is identifying your customer base and their needs. And then you need to get the right people in place to set up and run your operation. And that is, I believe, the biggest driver of your success because you you need to find the right balance of mortgage banking mindset and a traditional banker mindset. And as much as you hate creating stereotypes, um, in this case, they're both real, and you need it's a delicate balancing act of setting up the operation, getting the right people in to leverage the strengths of both approaches. Right, mortgage banking, very entrepreneurial. Banking, yeah, not so much. And but the safety and stability of a bank is part of what in the mortgage operation you're touting as to why you're different than your competitors. So it's getting the right folks to create the culture, drive drive the thought process to what you want to be, and then start building out your business model. And a lot of it these days is understanding the technology needs, and whether it's the big technology for the loan origination system or all the other ancillary technology tools that go along with it, finding the right combination, because certainly in the industry, every technology tool you could possibly imagine has been available, and people have gone out and gotten every technology tool that looks cool that promised to drive down the cost to originate, and the cost to originate keeps going higher and higher. So I think that's building that structure is to how you want to operate, and understand your customer base, right? You can be in many areas of the country where the latest whiz bang technology is not going to attract a lot of attention. So
Yeah.
Don't go down a path that's not appropriate for the customer base. And really build it from the ground up with your policies and procedures, and the right controls in place.
Yeah, that's great advice, Bill. And those policies and procedures, well, actually, as you define those right out the gate with your technology, a lot of automation out there that is making things faster and easier. But the policies and procedures will actually help reduce the learning curve of your new hires as well. So a lot of benefits there, and obviously regulatory reasons for the audits that that you have policies and procedures, and um, uh, those all play key parts in it.
Yeah, and recognize when you get into a bank environment, be the person that is requesting meetings with the compliance folks and the audit folks, requesting meetings with the regulators. Again, get out on the front foot and make sure that they understand, and they understand, if you're running a mortgage group, that you understand compliance is so critical in a banking environment, that everything has to be created with that in mind. Now, that doesn't mean a compliance approach takes away your ability to serve the customers, right? You've got to find the right balance, but it, if you're coming from a mortgage banking environment, it is different, and folks need to show that they get that from day one.
That's a really good point, Bill.
And I think then everything that's done needs to be done looking at it from the customer side. Right? That's where I believe a lot of these initiatives don't get the success, because they're trying to build it from the inside out. And bank customers, they have relationships with the banks, they have expectations. That's, in a way, it's good because you know exactly who your audience is, but you have to be laser focused in everything you do on how does this play from the customer perspective.
Great advice, Bill. And so let me ask you this. With all that said, as to what is on that checklist of things to do, I think you covered that very eloquently from an operations, technology, strategy, people standpoint. You've been advising a couple of banks here recently where the executive team is looking on the horizon. They're not looking at the environment today. They're looking on the horizon saying, I think there's opportunity in mortgage. Can you help us with, really vetting out the opportunity and helping us, design that framework? What's the response been from the bank executive teams and boards that you've met with as you've counseled and advised them? Have they been surprisingly optimistic that, wow, this isn't as overwhelming as I expected? Or have they been a little bit more shocked, or have they been a little more passive, where they're expressing interest, but they still don't get it? What's been that general response from those executives that you're consulting today?
So I think the first thing is to recognize that most of these decisions and thought processes are with a wide team of executives. And again, in a corporate structure where you don't necessarily have one person that is 98% of the vote. And they, as a group right now, are cautiously optimistic. They are very focused on what their concerns are, which in trying to help somebody is great because they're not in that, well, I'm concerned, but I can't articulate it why. They are they're doing their research and they are very focused and specific on how is this concern going to be addressed, and also generally realistic on right now is an investment for the future. Right now is not a time to jump into mortgage and make a boatload of money. That ship is sailed. But they're realistic in that, and so the right view of we've got an opportunity now. What does the return look like in 2, 3, 5 years? Not how fast can you ramp this up?
That's a really good point. You've got to have a long-term perspective when it comes to mortgage banking. This isn't something you just jump in and enjoy it while it lasts and jump out. Because as a bank, you have a big reputational risk, right? And you've got to make sure that you mitigate your exposure. So you're not looking to go deep and wide. You're looking to go long and hard, right?
Yeah, absolutely. And what I firmly believe and try and work through with folks is that from the product side, the right blend of bank portfolio product, let's say, and loans that are being sold, and recognizing that when you build that structure, then it's very easy to adjust the dials in terms of percentages going one way or the other on a month by month basis as the environment changes. There are lots of organizations I'm talking to now where liquidity was not a concern 2 months ago, and now it is. Well, if you build the right structure, you can adapt to those kind of changes very quickly.
Yeah, well said, Bill. That's spot on. Well, we have covered a lot of ground in a very short period of time, Bill. Is there any other key components or key items that bank executives should have in mind when if they're going to, hang up from hang up from this podcast, listening in and decide, okay, let's go explore. Where do they get started? How do they get started? They reach out to someone like you, a consulting organization like BlackFin, to say, hey, want to start a mortgage bank group? Can you give us, is that the right first next step?
Yeah. So a lot of folks they're all really smart folks. With you're not successful in an organization if you're not. But a lot of them, they know of mortgage. They probably not worked in mortgage in their career, and it's different. And I look at, obviously self-serving, but I look at us as you're hiring a specialist, right? And so many other things you do when you reach a certain point and you need more information, you reach out to a specialist. And I hope that would be BlackFin, where even just to get a conversation going and understand, well, is it right for my organization? How would we go about this? There's a lot of discussions that need to take place before folks will pull the trigger, and gathering information and banking on our experience, no pun intended, I think it'd be pretty helpful to folks.
Yeah, well said, Bill. No, I again hate to do shameless plug for BlackFin, but whether it's BlackFin or any other consulting firm that specializes in mortgage banking, that's going to be the key. You need to get aligned with someone who specializes in mortgage banking, who really understands all aspects of it, so that you can effectively build the organization from the ground up, as you mentioned early on, Bill. So I really appreciate that. Bill, I can't thank you enough for jumping into the shark cage with me today. And listeners, I hope you were challenged today to think in new ways about your business, about your bank, about the opportunity to be able to serve your community with a mortgage banking organization if you don't have one today, whether a community bank or a credit union or a regional bank. The opportunity is there. Thanks for listening. Stay tuned for the next Shark Cage podcast, where we'll bring in another amazing mortgage banking executive in to help you operate more efficiently and effectively and profitably. So we are here for your success. Have a great day. Thanks.
Thank you for joining us in the Shark Cage. To be a guest on a future episode, send an email to info@blackfin-group.com. To find out more about the show or the information provided in this episode, visit BlackFin Group online at www.blackfin-group.com.